Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jared Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. I'm your host, Jared Alexander, and today I'm super excited to dive deep into the space of multifamily with our guest, Zach Haptonstall. Zach, welcome to the show.
Yeah, thanks so much, Jared. Really excited to be on the show here. I know we've known each other for several years. You've been an investor with us, and thanks for having me on, man. Really looking forward to it.
Absolutely. Well, yeah, thanks for joining us today. And yeah, just excited to dive deep and talk multifamily, right? Talk about, your journey and how you got in the space of real estate and how you've grown your company over the past 5 years. And with that, just a little history on Zach here. I'm going to let you tell most of it here, Zach, but he's a Phoenix native, very impressive resume. CEO, co-founder of Rise48 Equity, Rise48 Communities, and Rise48 Construction, overseeing $1.4+ billion under asset management. I put plus because I think that number has probably went up a little, Zach, if I'm not mistaken.
Yeah, it's increased a little bit. I don't know. We don't keep track of it. That's good enough, right?
Okay. $1 billion in under asset management is pretty impressive there. So especially within 5 years, right?
Yeah.
And then, hey, real quick before we get started, I got to say I was driving my daughter, my 2-year-old, to a doctor's appointment. Poor girl, she had to go get some allergy tests, and that's never a fun thing. They got to scrape her and prick her and all that. But anyway, so we're driving to that, and as I'm headed down to 51 going south towards downtown, as I get off my exit right there, I think it's on 7th Street and like Bethany Home or over there, I see Rise 48 at the loft.
Okay.
So, yeah. See one of your apartment complexes there. And then I'm headed back south or going, headed north on the 51. And then I see your Rise 48, the Adopt a Highway.
Yeah, right.
Advertising there. So yeah, just wanted to highlight that.
Thanks for telling me. It's good to know that the marketing is working. That's good feedback. I appreciate that.
Yeah, absolutely. The marketing is definitely working for sure.
The funny thing is, Jared, real quick, I don't want to get off track, but a couple of years ago, we looked into billboards, and these billboards are like hundreds and hundreds of thousands of dollars a year if you run them all year. In Phoenix, it's crazy. The Adopt a Highway sign was like $3 or $4 grand for like 2 years.
Wow.
And you get thousands of cars drive by today. So anyways, if you're looking for promote your company, I'll highly recommend the Adopt a Highway strategy.
Yeah. I mean, yeah, 3,000 to 4,000. I mean, and we know how many people drive up and down that 51. And actually I've seen it on the 101 as well. So, I mean,
we got a few of them. Yeah.
Yeah. That's 2 good. Major freeways here in Phoenix, which is actually where, Zach and I are at here. So, all right. Well, yeah, it's a little sidebar there, but yeah, back on track. So Zach, if you could give us a little bit more about your background and how you got into real estate.
Yeah. Thanks so much, Jared. So yeah, I mean, I was born and raised here in Phoenix, just grew up in like a, typical lower middle class family, no real estate background, no family wealth or rich uncle or anything like that. And so I went to school. I wanted to be a football player. I had a Division II football scholarship, I went to a small school to play football, and then realized I wasn't going to go to the NFL. Went to get a journalism degree at Arizona State University to be a sports reporter and journalist, and was a live news anchor on Arizona PBS for a short time at a program through the school. So I was on like live TV, and I hosted a show on Fox Sports Network Arizona, which was cool at first. And then I just quickly realized like this isn't what I thought it was going to be. When it's your job, it's one thing to be a sports fan versus it being your job, and you don't hardly make any money. I had student debt. My parents couldn't afford to, help me with college, so I was working full time, nights and weekends to pay for school. And so, I got the journalism degree, realized I didn't want to do that and I needed to make money. So I went into healthcare marketing, working for a hospice company here in Phoenix, kind of an odd job, worked my way up from a marketer, director of marketing, became a president and co-owner of this hospice organization, got my MBA and was fortunate to make good money at a young age, be making six figures in my early 20s, buy a house, pay off all my debt. But I was miserable because I felt like I had golden handcuffs. I wasn't fulfilling my true potential. Everybody told me I had a great job, a great life, and I felt like I wasn't fulfilled. And so in January 2018, I didn't know anything about real estate or syndication, but I was just intrigued with real estate in general. And I had heard the whole concept of like passive income, financial freedom, all the cliches everybody's heard of, right? And so January 2018, which is now over 6 years ago, I quit my job. I sold the equity I had in that company. My goal was to live off of savings to figure out how to make money in real estate. And I was not thinking of multifamily or syndication at all, Jared. I didn't even know about that stuff. I was actually looking at like flipping houses initially. And then I basically took a few months where I was just trying to dive in and learn as much about real estate. And I quickly realized how overwhelming and expansive the industry is, right? And so real estate is just so many different things you could do. And so, I started to learn about, I realized I don't want to flip homes. It's very transactional. I started to learn about syndication, the whole concept that, I can leverage my time to, help other people deploy their money. And then I can earn sweat equity, for doing that because I had almost like 300K that I had relentlessly saved over those years that I was just burning through. And I was like, I've worked so hard, done well in this job, and now I feel like a failure because I'm burning through all this money. I want to like do something big. I want to launch all this money like a missile at some big goal to take myself to the next level. And I kept trying to figure out what can I do with this little pot of money, which I thought was a lot of money until you get into real estate. You realize it's nothing. 300K is nothing. Doesn't go very far, especially in commercial. And that's when I realized, I can't just be using my own money. I need to partner and leverage other people's money. And the whole idea of syndication was really attractive to me because that kind of clicked. I was like, that's how I can scale. I can build something really big and I'm benefiting other people. And, kind of leveraging my time and eventual expertise when I learn how to do this, how to benefit them. And so I was looking at mobile home parks initially, trying to, do mobile home parks. And then I finally settled on multifamily. And I really liked multifamily because I just thought it was a more attractive asset class overall for general investors to understand and to want to invest in. I liked the fact that, apartments aren't going anywhere. You can increase the rents to increase the value. So that's when I really settled on it. Long story short, it took 14 months when I quit the job to buy the first apartment building. And it was a 36 unit, $3.5 million deal here in Central Phoenix. And then, I met a couple of my business partners along the way at a conference, during that time. And, we bought that first deal. I put all my money into it. So I was dead broke. I had to sell my house to get more money to go tie up new deals. We started to then syndicate deals, raise money. And one thing led to another, we just kept grinding along. And now, we've purchased 48 different properties, over 1.8 billion of real estate, almost 9,000 units. We started a property management company, a construction management company, as you mentioned. We have over 240 plus full-time W-2 employees. We're based here in Phoenix, and then we also have an office in Dallas. And so, I go back and forth between Phoenix and Dallas, and those are our two markets right now. But, we've been fortunate to kind of, build out the company, and we just stay laser focused on value add multifamily investing. We don't do development. We don't do self-storage or any asset class. We're only buying existing, highly occupied cash flowing assets. And so, we've sold 11 of those deals now. We've renovated thousands of units, and we've really kind of learned a lot of the, trial and error of operating a business like this. And, the last 18 months, we've been going through this interest rate storm, right? And we've learned a lot about how, you need to adapt operationally to kind of get through the storm. We've learned a lot about how to properly communicate with investors. And we're in a good spot, fortunately, which a lot of people can't say. So
Yeah.
that's kind of how we got to where we are now, and so it feels like it's been like 10 or 15 years, but it's crazy. It's only been 6 years, since I kind of started on that journey.
Yeah. Well, and I tell you, Zach, I can see why it's seemed like 10 or 12 years. And just like you mentioned, I'm an investor of yours. I mean, I'll send you an email sometimes and I'll get a response, after business hours. And it just shows you the dedication, hard work you put into growing Rise 48 and the business in the past 5 years, because you don't get to 48 properties, right, without a lot of hard work. And I want to back up real quick though to the golden handcuffs you talked about, right? Because we grow up, it's our society, they teach us, hey, get a degree, graduate high school, get a college degree, find a job, work at it for 40 plus years, retire at the age of 65, and hopefully you got enough money to live off of for the rest of that time, right?
Right.
And with you and I, Zach, a lot of people, making six figures, right? They they like to be in our shoes, but they don't realize, I mean, like being a commission salesman, I mean, you get paid on what you sell, right?
That's
It's not
right.
like you're just
Yep.
salary based 100%. So like when me
Yep.
and my sales, I'm 100%, right? So
Yeah.
it's
100%. I know how that goes. Yeah. Yep. I know that feeling.
yeah. And it's so easy to just get tied into it. It's like you're making good money and you can live a good lifestyle off that, but at the same time to grow and just get past that, it's like there's like another little threshold. It's like another level there
Yep.
that and that's why they call it the golden handcuffs, right? Because it's just enough to keep us in that hamster wheel, right?
Yep. That's right.
Yeah. And this is one of the reasons, I started looking at multifamily myself and kind of what you mentioned, Zach. I mean, there's so many different streams and avenues you can go down in real estate. I mean, I started out in single family. We bought a rental out of state, and then I was gonna, I realized how many single family homes I would have to buy in order to scale to the degree I wanted to, and replace I mean, like you mentioned, time freedom, right? That's the goal. I just want more time freedom. So,
Yep.
fast forward, I came across, syndications and decided to go all in. And yeah, I've done, quite a few investments with you, but let's transition into you started Rise 48. What led, I mean, you touched on it a little bit. So you chose multifamily. I mean, and I just got to point out real quick, driving by some of these properties, you see I've seen the pictures of the units inside. Like they upgrade these stainless steel appliances. So not only are they a good investment opportunity, but they're creating a better living space for tenants, right? I mean, stainless steel appliances, granite countertops, new flooring, upgraded paint, and y'all keep
Yep.
it. I like what y'all do is you keep it simple throughout your whole portfolio. I mean, it's the same for what you do on pretty much every apartment complex, right?
That's right. Yeah. Rinse and
Yeah,
repeat. That's right.
rinse and repeat. So, well, Zach, let's go a little bit into, this podcast is tailored to the passive investor. So, say if investors just looking out at getting started in this space and they see Rise 48 and see Zach, and say, hey, I'm going to set up a call with Zach. What can they expect on a phone call? What questions do they need to ask? What does that process look like there?
Yeah, great question, Jared. Yeah, and I mean most of our, investors are coming from like referrals from somebody who's invested, or they find us online or whatever, they want to set up a call. And so typically I'll start out the call and I'll say, hey, tell me, hey Jared, tell me about your background and some of your investment goals. Like what are you looking to achieve? Right. And it's very common, most of our investors are W-2 workers who are making, good money, or they've been working on, an above average job for a long time, saving their money, business owners, people like that. And so most of them want to diversify away from the stock market, right? And they want to, start to earn passive income and really have some type of goal or runway towards being able to eventually quit their job where they're not having to rely on that W-2 income. And so basically, I still take calls with individual investors, and I think that's really important. And these are typically at least 30 to 40-minute calls. I just took 3 of them yesterday with new investors, for example, and 30 to 40 minutes, one of them was like almost an hour. And I basically go through our background, our track record of buying deals, selling deals. I give them realistic expectations of how long investment periods are looking to be for new deals right now. Because the first, 11 deals we bought, we sold them and doubled the money in like a year and a half. And I tell people that's not realistic. We never projected it on the front end. And we don't think it's going to happen, going forward because of interest rates, the economy. And then I tell them about, our infrastructure operations as far as the staff, the companies, how we structure everything from property management, construction management, supply chain. I talk about our business plan. And then I go into the actual structure of the investment. I tell them, explain to them, the 5-year projected investment horizon. I talk about the return metrics that we're typically projecting. I talk about the structure, like what their preferred return is, what is the GPLP split, how much actual cash flow can they expect to receive in year one, and how that all works. And then I talk about, the investor experience after we close, when we've acquired the property, like this is what your reporting looks like. This is what your distributions look like. Here's how we'll handle the tax implications and the K-1s. And then I'll kind of ask them, what is your timeline? Are you looking to deploy capital soon or maybe, a few months down the road? And I'll explain kind of the process of how to invest. Now that we had the call, establish this relationship, we'll put you on our list. We'll send out an email. And if you're interested, you can fill out a soft commit, sign the docs, wire the funds. And then I'll typically always follow up that call with like a past performance overview deck that kind of goes through the history of our company, kind of summarizes the call, and gives that. So that's kind of the typical process. And then a lot of them, we know how to answer a lot of these questions on the front end, just by kind of going through the structure. It kind of answers a lot of their questions. But if they have any other questions, they can ask those, afterwards. But that's kind of the process typically.
Yeah, no, thanks for sharing that. And if you don't mind just adding to, because, well, like for example, back in 2020 to 2021, in that 18 months to 2-year span, I mean, it was just on fire, right? I mean, y'all were turning these deals in 18 months to 24 months, I think you did 10 or 11 deals in that time period, right? Or something like that.
Yeah.
So, it was very attractive, right? And as an investor, you're looking at, oh man, these are exciting numbers, right? Doubling my money in 2 years, and getting to take advantage of all the tax benefits, right? I mean, super attractive. There nowhere else are you really finding those type of returns, and with the risk as mitigated as it is. I mean, it's a real estate, right? Brick and mortar asset. We can drive by these, see them, touch them, right? All that good stuff. So. So knowing what we know now with some of these interest rates, right? Can you talk about, maybe some projections that you had that didn't go as expected, and really just anything, investors need to be aware of as a risk? Because like as an investor myself, I want to know, hey, it's great to hear all the returns, but what are the risks involved? But of course, besides the risk of, it's an investment, right? Of course, worst case scenario, you can lose all your money, but some of the more realistic risk, again, this is a risk mitigated investment. So if you could just touch on that a little bit for us.
Yeah, absolutely. Yeah. So basically, as many people know, in March of 2022, the Fed began to aggressively increase interest rates, and they did 11 consecutive interest rate hikes, which was the most drastic increase in interest rates in over 40 years, since the 1980s. And this had a big impact on the economy as a whole. They were basically, inflation was running, rampant over 9%. They needed to get it back down. So they drastically started to increase rates. And, this affected all types of businesses. Office space is pretty much done. A ton of commercial office space is just getting foreclosed on across the country. You had multiple banks collapse last year, which you haven't seen since 2008, 2009. That was all, really due to interest rates. And then, it affected, of course, multifamily. And so with these multifamily value add loans, the majority of the loans used for the value add strategy across the country the last, 3 to 5 years have been floating rate loans.
Yeah.
And the majority of owners of these properties are large private equity firms like institutions, hedge funds, things like that. And so, we are a private equity company and we follow the same type of model. And so basically, at the time, like second half of 21, early 2022, we were putting these floating rate loans on these deals, and we were buying a 3-year interest rate cap, right? And most people were buying like a 1 or 2 year cap, and a lot of those groups have been in trouble and feeling the stress or distress of the market. We were buying 3-year caps, but we were buying a max interest rate cap somewhere between 5.5 to 6.5%. Okay, when we were buying the deal, our rate was like low to mid 3%. And in the model, we were assuming interest rates would increase 1 to 2% in the first 2 years, because that's what all of the indications were, from the Fed and, Chatham Financial, which is like an institutional finance tool that a lot of people use.
Yeah.
So we felt like we were being conservative, projecting interest rates would increase. But the problem is that they increased so quickly that within a matter of months after buying some of these deals, we assumed it'd go from like 3 to 4 or 5% in the first 2 years, when it went from 3 to like 6 or 6.5% all the way up to our cap in a matter of 3 to 6 months. Okay, so what that happens is your debt service just increases significantly, and this happened across the country, and a lot of these deals start to negatively cash flow, right? And so basically what started to become very common in the second half of 22 across the country and with us is that you have to pause distributions because you have to preserve liquidity at the property level. And so in 2023, we had a big push to renovate units at a faster pace. So we renovated almost 2,000 units in 2023, drastically increased the rents to increase the net operating income and the revenue to get a lot of these deals back to positive cash flow. So ever since we've started, even when we sold deals that were like, 18 months, double the money, every single deal we've ever bought, we do a 5-year horizon. Okay. So even the deals that we bought in 2021, we told investors in the model, we're going to sell this deal in 2026. Right. And so none of these projections, have not met what they were supposed to, because we sold the first 11 deals. The longest deal that we've owned, we bought it in June of 21. So we're coming up on year 3 of what was a 5-year projection. Now, when we were buying those deals, like you said, Jerry, because the market was so hot, a lot of investors thought, hey, I could probably sell this thing in 18, 24 months. Right. And we love to ride that wave all we can, and we would if we could. But as rates go up, values go down. Okay. So there's an inverted correlation there. And so in the short term, values are down across the country because interest rates are high. So now is a good time to buy deals if you can find them. It's very hard to find deals. In 2023, you had less transactions in multifamily across the United States than any year since like 2008, 2009. Okay. And it's because, the last time we sold a deal was July of 2022, right after rates started to go up. Because we're not going to sell a deal and give a buyer a discount in the short term. You know what I mean? We're going to hold through this. So when rates come back down, values go up, then we sell. So think of it kind of like a stock where we want to buy low, sell high, right? So right now when values are down, it doesn't make sense to sell. The only people that are really selling are groups that either are facing some type of distress or motivation, or they bought the deal a while ago and they have a low basis and they can still sell and make a little bit of money. So last year we bought deals where one deal we bought, literally the seller, and they were much bigger than us, been around a lot longer than us. We bought the deal for just over the loan amount. So they wiped out all their investor equity. All the investors lost their money. We bought deals where their interest rate cap was going to expire the next month. And so they had to sell at a low basis just before that interest rate came up because they weren't able to refinance the loan. And they also, didn't have the capital to buy a new interest rate cap. We bought deals where the loan was about to mature. And so you are seeing these opportunities where it's a good time to buy right now. But, those deals that we were buying in second half of 21, early 22, before those rates shot up, our biggest mistake is we should have bought lower interest rate caps so that there was no delta between the in-place rate and where the cap was. You know, in hindsight's 2020, it happened literally across the country. I
Mhm.
mean, you've got billions of dollars worth of loans facing the same challenge. And so after the second interest rate hike in May of 2022, we realized, okay, the writing's on the wall. The Fed is going to aggressively keep hiking these rates. So we adjusted our underwriting to buy much lower interest rate caps up front so that we were hitting our max cap day one and there's significant positive cash flow. Started to raise even more reserves, and we took lower leverage loans. So like the last 13 deals we bought since September of 22 till now, all those deals are positively cash flowing and they're all distributing every single month. And we're actually now starting to increase distributions as we head into year two of those investments. So we were able to adjust and adapt to the interest rate environment. It's just that the deals we bought right before those rates shot up, caught us by surprise and caught everybody by surprise. And so we're telling investors, hey, these are going to be more like at least 3 to 5 year investments because we have to weather this storm and, wait until rates come back down. Because when rates come down, values will go back up. Then we're in a position to refinance, or sell those deals. And so, yeah, those will be longer term holds, more in line with like the 5 year projection, that we were initially showing investors. But yeah, it just goes to show you, like you said, no matter what you're investing in, you just got to be aware of, different market conditions that can, kind of be in play. And there is no, like a lot of people like to say, oh, it's recession proof investment.
Yeah.
That's BS, right? It doesn't
Right.
exist.
Right.
Otherwise, everybody would do that, right? And
Yeah.
everybody would be rich. And so there's all kinds of investments that, have different variables. But overall, I think that if you're structuring the debt the right way, and you're able to execute the plan, the existing value add space can be a very, conservative type of investment class.
Yeah. Well, no, thanks for clarifying that. And again, like you said, hindsight's 2020, right? You don't know what you don't know, but the reason, I've invested with Rise48 and Zach here is because, they get out in front of, in front of it. So as they started going through this turbulent time, right? The communications, y'all were doing webinars, educating the investors on what's going on. What are y'all doing moving forward? Your project, and so as an investor, I appreciate that, right? I mean, I can't expect everything to go as planned, right? But I want an operator that's going to be transparent with me, tell me when things don't go as planned and what they're going to do about it moving forward, right? And
Yeah.
again, that's what I like about, Zach and Rise 48 there. And another thing too is I think this has helped as well. I mean, you touched on just pumping out these renovations on all these properties here on these, throughout your portfolio. That's due to their in-house, as you heard, the Rise construction, Rise 48 construction. They have in-house construction, in-house property management. So, I mean, Zach, I know you have warehouses of the materials, right? Pretty much supply houses of everything y'all need to, so y'all can be really efficient and hammering out these because we've seen, I mean, I'm in the construction industry as well, and
Right.
you see things are back ordered. It takes time to get stuff. Labor costs have gone up. I mean, that's a huge benefit to be able to be in control of over all that, right? When you
Yeah.
do, yeah, when you do have,
No,
your
it's
own,
huge.
yeah,
Yeah, it's huge. Yeah, you're right. I mean, yeah, I mean, most groups use third party property management, third party construction management, which there's nothing wrong with that necessarily. But, and we used to do it ourselves, but, we were fortunate that we started our own property management company, our own construction company, started to control our own supply chain before any of the interest rate challenges came. So we already had the vertical integration and kind of the streamlined operational approach where we have full control over all of our assets because all those on-site maintenance, leasing managers is all of our W-2 employees. So
right,
if somebody's not performing, we'll fire them.
yeah,
If we need to adjust a compensation structure to incentivize somebody to perform better, we will do that. Whereas when you're using third party, you just have less control. It makes things more difficult. And I think we've seen that, across the country. You've seen this big divide between the stronger operators and the operators that aren't performing as well. And a lot of them have third parties they're using, and it just makes it more difficult. And so we're grateful that we had kind of done that, on the front end and built that infrastructure out because I think it's very difficult to start a property management company. It's not a high profit margin business. We didn't break even for like 10 or 11 months. and that's normal for property management. You really do it for control and improve operations so that you can get better outcomes, for investors. And when investors are happy, they keep investing with you. And then that helps the investment company, which is the high profit margin business. And so yeah, I mean, having that infrastructure has given us really an operational advantage. And I can say to this date, we've never done a capital call. We don't plan on doing any capital calls this year and or next year, in 2024, 2025. And capital calls have become extremely common across the country. Everybody's doing it. There's people foreclosing on properties right now. We've never missed a debt service payment. We're in good standing with all of our lenders. And so a big part of that is having infrastructure where what you'll see when you start to talk to groups, and again, there's not a right or wrong way, but we've seen the difference is that most groups that are syndicators, a lot of them don't even live in the same market they're buying deals. Even fewer of them have their own employees, and most of them are using third parties.
Yeah.
Well, for us, we have a corporate office here in North Scottsdale in the Phoenix area. We have a corporate office in downtown Dallas, and everybody has to show up to the office or to their property, during business hours, Monday through Friday. We don't allow remote working, and there's a level of accountability and discipline that we've tried to establish. Where this is like a true private equity firm. You're not at your house, trying to act like you're working.
Right.
And we just don't believe that remote work is effective for this type of business because it's real estate. You got to get out and touch it and like you said, touch it, feel it, and be interacting with your clients, which are the residents. And so, yeah, so I think that's been a big part of it is that we've tried to create true infrastructure, a true company where you got to show up and, there's standards that need to be met. And I think that has translated to the performance of the assets.
Right. I like how you talk about the standards and the accountability that, you hold your team to and the employees as well. But I will share on the other side of that is they are super giving as well. Like I follow them on Facebook, Instagram. I mean, they're steadily holding parties, group, employee events where, they're team building, stuff like that. So, you definitely take care of your employees as well, which
Yeah,
again, you appreciate. You take care of people. They want to do right by you, right?
oh, 100%. Yeah, because I've been an employee. I mean, I didn't start as a business owner. I was always an employee. And what we realized is like, top caliber employees know that they're top caliber and they want to be compensated accordingly. They want to have a good culture. And so yeah, we're kind of unique that we cover 100% of all of our employees, medical, dental, vision, healthcare benefits, and then 50% of all their dependents. We have a 401k program. We match 3%. We do parties, we do all staff meetings, we do a monthly team lunch. So we do all these things,
Right.
And the people that perform and do their job, they appreciate that. They know they can make more money here than anybody else in the industry. But they also understand if I don't perform, then I'm not going to be here. And so I think it's just kind of having that fine line. And that's how you create a strong team, is like you got to get rid of the weak ones and you got to develop and build the strong people that, want to have a good attitude and want to work hard. And so that's kind of the key for us.
When you're looking at the operators and doing your due diligence, you always hear about that know, like, and trust factor, right? And Zach, getting to know you over these past few years, definitely build that trust factor for sure. I mean, hence why I've, invested, with you and your company.
No, thanks, Jared. We appreciate it, man.
Yeah, and I mean, and again, it's just you find somebody that like Zach, they're transparent with you. They have the communication. Thanks again for walking us through that call, Zach, because you want somebody, whoever you decide to have a phone call with, an operator you're doing some due diligence with or a discovery call. You want somebody to ask you, what are your goals, right? What are you looking for? Because I imagine, Zach, sometimes you hop on the phone with people and you're like, this is not the right investment for you, right?
And that's why I started doing that, Jared. I used to take these calls 4 or 5 years ago. I learned from experience. That's why I have like a spiel that I go through on schedule because it anticipates and answers most of their questions.
Right.
But I used to kick these calls off and just start sputtering everything about us. And then I would realize I just wasted my time because this guy is not going to invest or they don't have the money or they're not the type of profile or they're not even looking to invest. Maybe it's a vendor. Yeah. So that's why I always start off tell me about your goals and what you want to do. And I want to make sure it's a good fit. And if it seems like the type of, person that, invests with us frequently, then I know, okay, I'm not going to waste your time. You're not going to waste my time. And we'll go dive deep into the details and, give them a full overview.
Yeah, no, definitely. Well, and I just want to touch on one thing, whenever you were talking about the interest rates rising and pausing distributions, right? I mean, investors need to understand when you're getting into these deals, first of all, this is an illiquid investment, meaning in that 5-year hold period, that they're projecting in the business plan, you don't have access to that money. So if you need that
Right.
money to pay mortgage or live off of this, like, that's
Yep.
what happens in a discovery call. This is not the right investment for you.
Yep.
Right. And, and the same thing with the distributions, right? It's like, hey, you pause distributions. Yeah. It'd be nice to have them coming in monthly, but I don't need that money to live off of. It's just definitely things you need to consider before getting involved in the, syndication, primarily multifamily in this example. So,
Yep.
again, yeah, thanks for clarifying that, Zach, and diving into, I think just a real quick highlight on vertically integrated, right? I mean, that is huge. And I think that's a big reason why y'all are still performing, and you got the strength with your team and employees there to kind of weather the storm, right? On some of these deals that, got hit
Yeah.
with those floating rate debts. So,
Definitely.
yeah.
Definitely.
Well, let's transition into what I call the fire round here, Zach.
Fire around. Let's
Oh,
do it.
let's do it. So, if you could recommend a book on real estate for investors just starting out, and another book that is particularly good for cultivating a positive mindset.
I think that if you're just getting into it, what is it, The ABCs of Investing by Ken McElroy?
Ken
That's a good one.
McElroy. Yeah.
Yeah, I read that one when I was first starting, so I think that's a good one. ABCs of Investing, I think it's what it's called, by Ken McElroy. And then the other one was getting into like a positive mindset.
Yeah, like a mindset book.
Yeah, I mean, there's so many good ones out there. Lately I listen to a lot of I listen to Can't Hurt Me over and over by David Goggins. He's like a former Navy SEAL. I listened
Yeah.
to Winning and Relentless by Tim Grover. He was like the former personal trainer for Michael Jordan and Kobe.
Yeah.
Like when I'm working out, I'll just listen to certain chapters over and over just to kind of develop like a warrior mindset.
Yeah.
It's more of like if you want to if you're going through some stuff and you need to have like the tough mindset, to endure. I think that How to Think and Grow Rich is like a timeless classic, right? By Napoleon Hill. That's a good positive mindset one. I listened to that over and over when I was trying to start this company to just try to envision and, take the steps necessary to get to that next level.
No, it's super important. You probably know more than anybody, Zach. I mean, being in this space, there's those days where you're just like, I don't want to keep doing this. Like it's hard. It's hard work to
Yeah.
day in and day out, right? And so these books and this, I mean, what do they say? It's like 80% mindset, right?
Yeah, exactly. Yeah, you gotta have your mind right. And it also comes down to like having good personal habits. Like make sure you have a consistent exercise regimen, you're eating well, you're staying hydrated, you're getting enough sleep. All these things will contribute to your mental well-being and your emotional well-being, which allows you to, I call it mental and emotional endurance. So you can keep grinding, overcoming challenges, and get through adversity.
Yeah. No, absolutely. Well, that'll be kind of a segue into my next question then. So what's a daily habit you practice to keep on track towards your goals?
Yeah, I mean, I drink at least like 1.5 to 2 gallons of water a day. So I stay like, super hydrated. I eat the same breakfast every single morning. So I basically eat like egg whites, turkey bacon, piece of toast with almond butter, protein shake. I work out, 4 times a week. Like on Sundays, I'll work out for like 5 or 6 straight hours, and I just really try to
Wow.
like kill myself, like cardio wise, so get my mind ready for any challenges I'll endure during the week. So I'm really big on just sticking to my routine of working out, hydration, eating clean, because all these things contribute to your energy, and your mental mindset. And then I just always, don't get too high or too low. Just try to stay consistent, because then you can overcome a lot of stuff. And as we've grown and you start to have staff and employees and a team, you realize that all eyes are on you at all times. So if you show weakness, your people will see that, and if you seem frantic or stressed, they'll see that. But it works in the opposite direction. If you're positive and you're bringing that energy and you're hungry and you're working hard and you're showing up and you're the last one to leave, which I'm always the last one to leave this office every single day. Like I literally will not leave if there's another car in the parking lot. I'll just wait. And all these little things, they start to matter, and you can kind of lead by example. So these are all the things, like if you don't get yourself right, then you cannot lead other people, and help them to get themselves right. And so I think that all these things are, really important for me.
Real quick, what are you doing cardio for 5 hours? Are you just running or?
Well, no, it's not just straight cardio. So
Yeah.
basically, I do deep stretching for an hour, and then I do
Okay.
like a pretty in-depth core workout, and then I do 50 minutes of an intense stair stepper, like at the highest setting, and
Yeah.
then I stretch again, and then I go to the gym and I do a leg workout, like my leg workout. Like so, I'll try to do all that on Sundays, because I just don't have time during the week to do that,
Yeah.
And so, and yeah, I mean, it's just I tell people like, like this doesn't apply to all companies or entrepreneurs, but like, to grow and to maintain, you know, a high level of performance, it's like a lifestyle, and it's a sacrifice that you have to make. Like my partner Bikram and I, we're here at this office 9 a.m. to 9 p.m. every night, Monday through Thursday. No exaggeration. And we'll leave out 7 p.m. on Fridays, but we keep our operations staff. We have a 3 p.m. to 7 p.m. meeting every Friday, and we go through every single asset. And so, we keep them here to grind through it. And they're highly paid. They make more money than anywhere else they'll make in the industry, and they like working here. But it's just kind of that, that dedication, and we love to do it. But it's a lifestyle. So, I may not be able to go to family events other people go to, other stuff like that. And so, that's kind of what we like to do, where we're fully committed, to the company, because it's not just our company; it's really like our life.
Yeah. Well, there
Passionate.
you go, folks. Yeah. The dedicated hard work, right? This path is not easy, but it's definitely rewarding.
Yeah.
So that's awesome, Zach. Well, I'm gonna just skip to my last question here to be respectful of your time, Zach. If you could be remembered for one thing, what would that be?
Yeah, honestly, I want to be remembered as like, if I'm fortunate enough to like inspire other people, and have helped them, like I want to be an impression. Like, so like I'm Christian, I believe Jesus Christ, my Lord and Savior, and every morning I pray on the way to work, like while I'm driving, which may not, may not be like what most people do, but I always pray and I say, Lord, give me the strength and the courage and determination to inspire other people, and the people around me. And so that's what I'm trying to do is, whether it's our team, my family, our investors, there's people that maybe listen to this podcast and that they're trying to start their own company, or, they're going through tough times. Like I have gone through those dark times, when I was broke and I went to credit card debt trying to start my company, and everybody tells you can't do it. And then even when we start to become successful, and then I have to fight the media making stuff up about me, and you start to get haters and critics. So like I can relate to people going through adversity, and I just want to be able to, lead an example and hopefully help inspire them to kind of pursue their goals. That's the biggest thing, because I've known that I've drawn inspiration from other people that I don't even know. They don't know me. They don't know what they've done for me just by listening to their book or whatever it is. And so if I can do that, that's kind of a cool thing, because it makes a difference, and you don't know how big it could be. It could be huge. It's kind of the cool thing.
Yeah, no, that's awesome, Zach. And there's no question you're doing that. So, and we'll be continuing to do that as well. So yeah, no, that's awesome. Well, thanks again for joining us, Zach. I really enjoyed this conversation we had today. And if you could tell listeners if they want to connect with you, where they can do that at.
Yeah, thanks so much, Jared. You can just go to our website, rise48equity.com, or you can email me, ZACH, at rise48equity.com. And we look forward to partnering with Jared as a fund manager. You can invest with Jared to partner with us, in future deals.
Yeah, that's awesome. I like the call out there, Zach. Yeah.
Yeah,
For
that's right.
sure. Yeah. I'm sure we would definitely be partnering here in the near future. So looking forward to that as well. And Zach, thanks again. I'm going to let you go here because I know you got another commitment, but and we'll be talking soon.
All right. Sounds good. Thanks so much, Jared. Really appreciate it, man.
Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.